let's be real, you've got over 2 decades in this, like, to get to that point.
True. Absolutely. That's why Wiley came to me and asked me to write a book on it, because they wanted me to sort of share some of the insights from 20 years of doing this, how we do it. In many ways, it's written for financial advisors, so that way they can understand more. But I think I wrote it in a way that, for the most part, the layperson can understand most of what we're doing.
Welcome to the Child Free Wealth Podcast, hosted by Bree and Dr. J, Certified Financial Planner. Here we discuss life and finances as it relates to being child-free. This podcast is for educational and entertainment purposes only. Please consult your advisor before implementing any ideas heard on this podcast.
Hey, Child Free Wealth listeners, we are going to dive into how to make your investments match your values. Is it possible? Kind of what does it mean to look at like sustainable investing and ESG and all these terms? And to do that, I brought in a friend, Pete Krull, who runs a company called Earth Equity Advisors. But he's got a book out on sustainable investing, and he was the 2024 Investment News ESG Responsible Investing Advisor of the Year. And like, he talks about this stuff all the time. So we're going to pull apart kind of like, is it possible? What are the limitations? All of that around your investing, and how does it match you? Pete, welcome to the podcast.
Thanks, Jay. I'm really excited to be here. It was great running into at a couple conferences this year, and I'm glad that we were able to make this happen.
Absolutely. All right, let's be real. We're here in 2025 in a rather political world where, a lot of terms are getting thrown around. ESG is now a bad term. DEI is a bad term. Like, how do you look at, values and investing in a current political world?
Yeah, it's like, what's the acronym du jour, right? I think the way we look at what we call sustainable investing, and we'll get into what some of the differences are of these, but just to give sort of a 40,000-foot view, is that people who are interested in investing sustainably are going to be interested in investing sustainably no matter who's in Washington, no matter who is in their state capital. We've been doing this now. This is our 21st year. And so we've been through a number of different administrations. We have been through a number of different sort of mindsets on, how we should incentivize the next economy. And so for us, just continuing to do the same thing and doing it in a way that is structured and, repeatable is something that is really important to us.
But I mean, there has been a change. I don't know, half, 2/3 of our clients do some type of ESG investing. But I've heard a bit more this year of like, I've got to do something.
Yeah.
Is that fair?
Oh, absolutely. If we go back to the first Trump administration, so 2016 to 2020, we saw some of the biggest increases in new clients coming to us over that time, because people understood that what wasn't going to happen legislatively or through an administration, they were going to have to really push the agenda on the private side. And we've seen the same thing again over the last, 9 months or so, that people are coming to us and saying, hey, we really want to invest with our values. How can you help us do that?
Yeah, and I think it was the last administration, and I apologize if they all kind of come together, but there was this push that, ESG should not be a criteria that financial advisors talk about. Like, essentially, they're trying to like almost outlaw us talking about it. I mean, talk about that.
I think it's interesting that I don't want to get too political, but the party that is all for deregulation wants to regulate this. It doesn't really sort of jive, but then again, hypocrisy just sort of happens, right? There's been a lot of talk in retirement plans, for example, about, you can't use ESG metrics in retirement plans. Well, that's just, ludicrous. If somebody wants to invest sustainably, then they should be able to invest that way. Don't tell them what they can or cannot do. But I think that a lot of this comes down to messaging and really understanding what ESG is. So I think this is a perfect place to sort of insert what is the definition of ESG and why has it become such a naughty word, if you will. So ESG stands for environmental, social, and governance. And it was part of a United Nations, I think it was a white paper or something of that order, going back to the early 2000s. And when they came out with that, they basically said, look, in order to have better due diligence, it's probably good that if investment advisors actually take a look at what are the environmental risks on a company, what are the social risks on a company, and what are the governance risks on a company. And I think what's critical is the on a company part of that, because what we've been led to believe by politicians and a lot of the media is that ESG is the impact of a company on the world around it. It's what is the environmental impact of this company? What is the environment or social impact, et cetera? But what ESG is actually the opposite of that. It is what is the environmental risk on the company? What is the social risk on the company? By that definition, which is the true definition of it, it's a due diligence process. It's a due diligence tool. So, for example, if I am researching a company and they have a manufacturing facility that is on the coast of Florida, is that an environmental risk on the company? Absolutely it is, because we're seeing hurricanes that are becoming more frequent and more intense. And that is a material potential impact on that company because of a location of one of their facilities.
But the reality check is it's kind of a bit of both. You know, if it's going to be a negative impact to the company, it's probably a negative impact to the environment too. You know, fossil fuels is kind of one of those examples.
Hey, Child Free Wealth listeners, it's Bree. I highly encourage you to schedule a Child Free Wealth checkup. During this time, you're going to get a couple of forms to fill out that include your life and financial plan. We'll review them, and then we're going to have a meeting and go through them with you. We're going to give you some advice and things to work on and talk through things to make your finances simpler so your life can be amazing. You can schedule yours by going to our website, childfreewealth.com, and clicking the Schedule Now button.
Yeah, absolutely. But the metrics that are actually out in the system isn't the opposite way. It isn't necessarily the externalization. It's the internal risk on the company. Yes, if I don't want to own fossil fuels, which we don't, we are fossil fuel free, that is a decision, but that's based on sustainability, not necessarily on ESG metrics. And that's really where the difference starts to play in. So when we look at sustainable investing, again, which is what we've been doing for 20 some years, it's more of a ground up approach. So ESG, conversely, is a top down. So you typically will take an index, you will layer on those ESG risk metrics, and you will make adjustments to that index based on those risk metrics. And I like to sort of kid that what you end up with is a less bad portfolio, but ultimately that's really sort of what it is. Whereas from our definition, a sustainable investment or a sustainable portfolio is built from the ground up. It's asking the questions, what are the companies that are going to be leaders in a cleaner, more resource efficient, more resilient, and more equitable economy?
Yeah, and I often will explain it as kind of opt-in versus opt-out. The kind of easy way, and I'll be frank, this is how I invest, is my ESG portfolio is kind of taken out the naughty list.
Yeah.
You know, it is the less evil version. I mean, that is it. I mean, it's not saying it's not evil or not bad or whatever. It's less. And I think the challenge is when we go to kind of the opt-in and we're trying to pick which companies we think match our values, match our thing, you can get to a point where like there's almost nothing you can invest in. And I say that kind of tongue in cheek, but it is kind of the case. I explain it's like The Good Place. So if you haven't watched the show The Good Place, they talk about like who gets points for going to the good place versus the bad place. And they finally find, spoiler alert, that the answer is there's no such way to win good points because everything has a root of evil.
Yep.
And that's kind of true in our investing world.
Yeah, there's lots of gray. There's always going to be lots of gray in this. What we really try to do is we try to look at sectors and industries that are going to be, leading the way either now or in the future. And I live in Asheville, North Carolina. We dealt with Hurricane Helene back in September of 2024. And I learned a lot during that period. I learned that we were not prepared for the changed climate. And one of the things that I learned is I stopped calling it climate change because it's a changed climate. It's here, it's happening, and we're dealing with the consequences of it. But we weren't ready from an infrastructure perspective. So we had a failure of our communications infrastructure. We had a failure of our transportation infrastructure, and we had a failure of our utility infrastructure here. We lost water for 2 months. We didn't have any kind of internet or cell coverage for weeks. And roads, if I was to drive from here to you on Route 40, we couldn't have done so because the road was washed out. One of the areas that I decided at that point was going to be like really important to put into portfolios was infrastructure, because it's one of those things where If we're not prepared, we're going to have more and more of these events happen. When you look at an infrastructure investment, it's not always going to be the greenest of investments. But if you look at it from a resilience perspective, it is an absolute necessity for where we are right now. And this event has really pushed me. So when I started this firm back in 2004, SRI stood for socially responsible investing. And it sort of moved through different iterations to sustainable and responsible investing. But the thing that really struck me post-Helene was that we need to change the definition of it. And so we've started calling it sustainable, resilient, and innovation investing. Sustainable because we need to reduce our impact because we still have a chance to make an impact. So that way future generations, I know you and I and the rest of the childless folks here, yes, I am one of the tribe, aren't necessarily, we don't have a future generation, but a lot of people do. So we want them to be able to thrive as much as they can. Resilient, obviously, because we need to be more adaptive. We need to be able to deal with the impacts that are coming our way. And innovation, because it's really what ties it all together. It's the definition in many ways of our generation.
Yeah, and by the way, Pete mentioned this US 40, and I happen to actually have driven it recently. I went from Tennessee out to Charlotte, Mooresville area in North Carolina, and you watch these giant sections of this mountain and river like washed away.
Yeah.
I mean, just huge 100-foot plus drops gone. And it's amazing to see it. And when you see that, you're like, first of all, you realize the power of nature. I mean, let's just be real on that. But then you're like, and this is what we're doing to it. And I want to circle back for a second because you brought up sustainability and together with child-free stuff. And this is actually a topic I'm working on. I'm doing a TEDx talk later this year and talking about how if we're going to embrace child-free folks, really we are talking about having to embrace a sustainable growth picture. But the problem is some folks look at that and go, well, that's going to be less growth. Because it is. If the population stays where it's at, you're going to see about a 4% reduction in the GDP over the next 20, 25 years. And some people see that as bad. I go, well, by the measure, it may be bad, but it's good for our world. Like, how do you square that?
Well, I mean, what is the definition of unlimited growth, right? It's cancer. Ultimately, that's not necessarily a good thing. I think that we can be smart about growth. I think that we can, limit our impact. We're at, what, 8 billion people or something ridiculous like that now, well past our carrying capacity. And we need to start working, not necessarily as a country, but as an entire society, an entire global society, to understand how can we become less impactful on the earth so that way those people who do have future generations, those future generations won't have a lower and lower standard of living, which is ultimately going to happen if we continue to procreate at the pace that we have for the past several decades at least.
Right. But then I get people saying, well, you guys being child-free folks are going to destroy Social Security because we don't have constant growth. And, the economy is all based on constant growth and profits will go down if we're not constant growth. Like, to me, I'm like, that's not a bad thing.
Yeah.
But I think it's just so hard in the economist world or the financial world to see that.
I think it's a small group of people. It's those economists that are so brainwashed into the idea that we must have growth for growth's sake, as opposed to people who are thinking, well, let's have smart growth. And that's the difference. Let's think about why we want to grow. Let's not grow just because we can increase earnings. Let's grow in a way that is going to be smarter. A sustainable portfolio is meant for growth because we don't necessarily have a sustainable economy right now. So what happens when we start to scale back from fossil fuels? Well, we want to electrify the economy. That is going to take tons and tons and tons of capital. That's going to take lots of jobs. That's going to take a lot of growth, but it's going to be smart growth. It's not going to be the kind of growth that you're talking about that these economists just can't get out of their head.
Well, and I think this is where some clients will kind of push back and they're like, look, the whole capitalism system's broke and, there's a whole bunch of bad actors, bad, motives, whatever you want to call it.
Yeah.
And at some points I kind of go, yeah, I can't disagree. And then they go, well, but if I'm investing in the market, am I supporting those bad actors? It's not as black and white. It is gray, but how do you see that?
Well, I think it's about directing where your investment goes. I mean, the market is the market. If you want to grow your portfolio so that way you can have a comfortable retirement or all the things that people actually are investing for, you don't have a whole lot of other ways. If you can invest in a way that, for example, you're not investing in the S&P 500, which gives you a little bit of everything, so that way you do have the bad players. You might have some of the good players, but you've got a lot of the bad players. If you can be, again, this is like smart growth. Smart investing is really sort of directing how you're putting those monies. Yeah, is it going to be pure? No, nothing is ever going to be pure. Is it going to be better? Absolutely. And you got to different levels, Jay, like you were talking about. You do your version of ESG is sort of the less bad kind. There's another layer to that. There's always going to be multiple layers, but they're always going to be gray. How can we put portfolios together that, really align with people's values and really the way they want to see the world? Obviously, make a competitive return and, do as little bad as we possibly can.
Yeah, and there's a tool, I think it was Morningstar, and I could be wrong on the brand, but it's a tool that you can measure and say, okay, how much do I hate XYZ, and how much am I willing to give up in my portfolio to make that balance?
Right.
So if I use the fossil fuel example, the opt-out gets rid of most of the fossil fuel stuff, and you do lose a little bit of that gain that you might get by investing in oil. Now, I look at it and say, well, I'm giving up short-term gain for long-term environmental gain, long-term company gain, long-term benefit. But there is kind of a trade-off. Is that fair?
Not necessarily, no. If you look at the study that Jeremy Grantham did several years ago on what he did is they extracted, and I like to use that word, every sector from the S&P 500, and then they took that back 25 years and they took it back 50 years. And the delta between the best performing portfolio minus an individual sector and the best and the worst relative to the S&P 500 was only 50 basis points over an extended period of time. And actually, in his study, if you took out fossil fuels, you performed better. Now, fossil fuels are directly linked to commodities, right? That is always going to be, it's the fundamentals of fossil fuel companies aren't as important as the price of the commodity at the end of the day. So they're going to trade based on where the price of oil or natural gas or whatever, coal, whatever commodity they're digging up out of the ground. But when you look at, for example, if you look at the period going from, I want to say about 2010 to 2020, give or take, you didn't make a penny in fossil fuels. Don't quote me exactly on that, but there was about a 10-year period where fossil fuels didn't do a damn thing. If you want to invest in a way that is sustainable, if you want to simply invest in a way where you don't own one of the sectors, it's not going to kick your ass. It should not hurt you.
Yeah, and I mean, there's a balancing act, and I'm okay wiping out fossil fuels from my portfolio. That's a personal choice. I think we're big proponents of long-term passive investing, low cost, and that's why we've settled on this kind of opt-out as kind of a middle ground. We use the Vanguard set of ESG funds. There's a small additional fee, but I mean, relatively small. And if you look at the return year over year of the broad market versus the ESG version for Vanguard, there's nearly no difference. I mean, it's not enough to make a difference.
Yep.
And I said to clients, hey, here's a good first step. Then if you want to go deeper, you can go and kind of looking at specific funds that are opt-in. You can shift some of your money in there. But then they start having this debate of like, well, do I want to pay higher fees, other things, or do I want to give to charity? Which is the way I want to use my money to match my values? And how do you balance that?
We do both, clients. I would say 90% of our clients, we manage their entire portfolio. And all of the portfolios that we manage, for the most part, are mostly the opt-in kind of portfolios. Our clients are very philanthropically minded. So, we do a whole lot of gifting, because that's just sort of, I like to use the word our tribe, but that's what the way our tribe thinks and the way they live their lives. I don't look at it as being an either or. I look at it as both and our clients tend to as well. One of the things that I think it's important for people to think or to realize is that when you look at a truly sustainable portfolio, it's almost always going to fall on the growth side of things. So if you've got an investment grid where you've got value on one side, growth, and blend in the middle, sustainable portfolios almost always fall on the growth side because they're investing in where the economy is going, not necessarily in more traditional kinds of companies. So you're not always going to outperform. And we saw that back in 2021, 2022, when we shifted more to a value bias after having such a strong growth bias, especially in 2020. But when the thing that we've learned with working with sustainable investors over a long term is that they see that this is not an overnight change. This is a paradigm shift. And paradigm shifts take a much longer period of time to really make that change. Switching from fossil fuels to an electric-based economy is not going to happen overnight. I'm not an idiot to think that that's going to happen. When we look at investing for the long term, like you just talked about, that is where our clients typically are. And, I started in this business back in 1998. CNBC was around, but it wasn't this frantic amount of information. The internet wasn't as prevalent. You didn't see companies like Walmart, for example, putting out their weekly sales figures, because weekly sales figures do not really show trends. Those are just weekly sales figures. And people had more of a mindset of long-term investing. But what we've really turned into over the last 20 years or so is we focus on short-term speculation at the expense of long-term investing. And so CEOs can't lay out a plan for really making transitions over 5, 10, 20-year periods, because they've got to answer to shareholders who want to see them making money on a quarterly basis. And I think that there's a problem with that.
Oh, there is. I mean, this is one of those questions of like, if you're just trying to make that quarter, do you cut corners? And the answer is yes, you do. I mean, let's just call that out. And, the environment, well, boy, that's the last on the list.
Yeah.
But you're also seeing it in kind of a lot of the political stuff right now where people are like going with the whims. This is Target who decide, hey, they're going to go away from the DEI stuff and had the boycott and all these things. Like, either your principles stay with you or they don't. And if you're living quarter by quarter, you don't have principles.
Yeah, spot on. That is absolutely true. And we had a client who emailed us and said, hey, what are the companies that have dropped their DEI policies, and do we own any of them? And I went through both the mutual funds and ETFs that we own and the individual stocks in our individual stock portfolio. And I think I found 1 or 2 companies in there that had done so. And they were in the funds. They weren't in our individual stock portfolio. And I think on a percentage basis, I was actually happy with that. That means that we've done something right in the way that we structured our portfolios.
And what'd you do with those companies? Did you cut them out, or are you like?
Well, they're in funds, so we really can't. I mean, if they're a 1 or 2% allocation in a fund, or a mutual fund or ETF, there's not much we can do about that. So long as the vast majority of that fund is in things that we want to do. I mean, we will switch out of funds if they add fossil fuels, which we've seen before in some very specific ESG or sustainable kind of funds. But, for the most part, we give them a little bit of slack because, again, there's tons of gray in the market here.
Well, and I think the reason I ask that is there's if you go into investing and you want to be absolute, you're like, I absolutely don't want to invest in these couple of things. It's really, really hard. It's not because it's wrong. It's just there's way too much to it, So you'll see these funds, there's some that specifically work on making sure they have good representation of women on boards.
Yep.
Great. Well, some of them are invested in fossil fuels. This is that up and down. And how do you find that balance? And it does get to kind of this paralysis analysis routine of I look at too much and I just can't invest in anything.
Right, which is why it's so important to have a process and be able to communicate that process. So our individual stock portfolio called Green Sage Sustainability Portfolio, we've been running since 2012. So we're in our 13th year right now of running this portfolio. The longer I do it, the more complex it gets because I get more and more data. I get the ability to process all that data using massive spreadsheets, which I just finished last month. So I'm a little grayer, I think, because of it. But we can add in things like women on boards or women in the C-suite. We can add those things in, and it's a piece of the puzzle. And I think that's how we look at it for example, when I put this portfolio together, we create 3 composites. We create a fundamental composite. So we're looking at everything from, price earnings ratio, price to cash, all the typical fundamentals that you would want to see analyzed because obviously we're a fiduciary. So that's going to be an important part of it. We look at ESG ratings from Sustainalytics and MSCI. And then we look at street ratings. What does everybody else on the street think about this particular company? And we create a composite for each one of those, as well as a total composite. And it's not the be-all, end-all. We don't pick specifically based on those numbers, but it gives us some guidance as to how companies are performing relative to other companies in the entire universe, relative to companies within their sector, and relative to companies within sector, universe, and within the index.
How much time does that actually take? And by the way, hopefully AI will be able to help you in the future. But I was trying to explain to a client, in the opt-in world, you could be spending weeks looking at companies just to pick one.
Right. So I maintain a universe, which is probably the most important thing to do. So I've got a universe where we both add and subtract companies from it on a regular basis, but we rebalance every 6 months. So if this was a continually managed portfolio, it would be a full-time job. But since we rebalance it every 6 months, it takes 2 to 3 weeks typically to go through rebalance where we're looking at every single company. Every single company is able to be removed. Every single company is able to be put back in, and then try to balance out everything that gets balanced in there. I mean, this is intricate. You've got to be able to balance out market cap size. It's typically 50% large cap, 30% mid cap, 20% small cap. You've got to balance out domestic versus international, typically 2/3 domestic, 1/3 international. We've got to balance out making sure we don't have too much in any particular sector. So that way we are as diversified as possible without owning sectors like fossil fuels. Yeah, for me, it's come down to a process that I won't say do in my sleep, but almost do in my sleep at this point. For somebody to just jump in and do it by themselves, good luck.
Well, and I mean, let's be real. You've got over 2 decades in this, like, to get to that point.
True. Absolutely. That's why Wiley came to me and asked me to write a book on it, because they wanted me to sort of share some of the insights from 20 years of doing this, how we do it. In many ways, it's written for financial advisors, so that way they can understand more. But I think I wrote it in a way that, for the most part, the layperson can understand most of what we're doing.
Yeah, I got a copy of the book in advance, so I was really excited to dig into it. And it's interesting because I feel like I have a decent grasp of it, but you're definitely way ahead of me. And it's like, oh, I didn't think of that. And, I think that's the challenge, is just deepening the conversation over time.
Right. Absolutely. And it's about growth. So, I mean, we talked about growth earlier, right? But, the sustainable investing, industry, while it has grown, and there's a lot of ESG out there, I think this is something interesting too that we haven't mentioned, but have you heard of the term green hushing?
No. I have green washing, but not green hushing.
This is green hushing. It's sort of the opposite in many ways. Because of all this political pressure, you will see fewer companies advertising that they're doing ESG or advertising that they're doing this level of due diligence, but they're still doing it. They're just doing it as part of their normal investment process. You just won't see it on their masthead. You won't see it in the details, because ESG is part of a due diligence process. It's not necessarily anything special. There's a joke in our industry. It is, what do they call ESG or sustainable investing in Europe? They call it investing, because they pretty much all integrated it as part of their process.
Hey listeners, like what you're hearing? Don't miss a thing. Sign up for the Child Free Wealth newsletter for weekly tips, tools, and podcast updates. Head to childfreewealth.com/newsletter to get on the list.
Yeah, and let's be real, all the political stuff and what are you willing to stand up for and all that, that's a big issue. We're pretty loud in what we do and how we support our community, but that's up to everybody. Like, you have to figure out the balance. I mean, is it worth taking the battle? And I don't blame people when they're like, hey, I'm going to quietly do the right thing, but not be loud about it.
Yeah, I mean, it's sort of that idea of keeping your powder dry, right? Because the political environment will shift at some point again, and you may be able to go back out and maybe you won't be quite as loud as you were before because those elements still exist out there, but you'll be able to at least market yourself a little bit in that manner.
Where can they find the book? Where can they connect with you?
Okay, so the book comes out in October. We're recording this in June right now, but you can go to sustainableinvestorbook.com and pre-order it at this point. That's just, and I'm sure you'll put that in the show notes. But if you want to check out more about Earth Equity, it's just simply earthequity.com.
Great. Well, thanks for joining us.
Jay, this has been an absolute pleasure. I love talking about what we do. I absolutely love what you do. I know when we met in Miami, I actually sought you out because I absolutely love the concept of child-free investing, or just child-free, folks who have made an intentional decision to go it alone. My wife and I went through a process. We are child-free, and proudly so.
Well, can't say better than that.
If you enjoyed the show, please consider leaving a rating or review. We'd love to keep the conversation going. Please let us know your thoughts wherever comments are available, or email us at media@childfreewealth.com. To stay up to date, find and follow Child Free Wealth on social media. If you're interested in working with us, learn more by visiting our website, childfreewealth.com. We'll see you next time.